The exits locked. Not announced. Not debated. Just closed. Capital channels that moved money across borders freely yesterday aren't moving it today. Exchange rates that cleared transactions smoothly are frozen at levels that make no sense. Money that was flowing stopped, went silent. And if you're holding assets in currencies that just lost their exit routes, you're not early to this crisis. You're trapped in it. The authorities clamped control without warning, and the people who saw this coming already moved their money, already repositioned, already got out, while you were assuming the exits would stay open. Markets expected gradual currency adjustment this week, normal volatility, natural flows, capital moving to where returns were strongest. That's how currency markets are supposed to work. Money seeks opportunity. Exchange rates adjust. The system balances itself through millions of transactions. Smooth, continuous, predictable. Except the adjustment didn't happen. Capital channels tightened suddenly. Restrictions appeared overnight. Exchange windows that were open closed, and money that should have moved according to market forces stayed exactly where authorities wanted it. Not because market participants chose to keep it there, because they weren't given a choice. This shouldn't be happening. Strong currencies attract capital. They don't trap it. When a currency is healthy, when an economy is stable, when authorities are confident, capital flows freely. Investors move money in, move money out. Exchange happens at market rates. The exits stay open because authorities know capital will return, because the fundamentals are solid, because confidence is real. But when authorities suddenly restrict exits, when they freeze exchange rates, when they clamp control on capital movement, that's not strength. That's fear. Fear that if the exits stay open, everyone will use them. That if capital can move freely, it will move away. That if exchange rates clear naturally, they'll clear at levels that reveal how weak things actually are. The timing reveals everything. No crisis was announced. No emergency declared. Markets were trading normally. Then, overnight, restrictions appeared. New rules, new limits, new controls on currency exchange. And the explanation was always the same. Temporary measures, stability management, orderly market maintenance. But temporary measures that appear without warning aren't temporary. They're desperate. And stability management that requires suddenly restricting exits isn't managing stability. It's containing panic that hasn't become visible yet. The authorities are buying time, and they're buying it by trapping your capital. This keeps happening. Not just in one currency, not just in one market. The pattern is spreading. One jurisdiction restricts capital flows, then another, then a third. Each one citing different reasons, each one claiming temporary necessity. But the pattern is identical. Authorities sense pressure building, sense capital preparing to move. And instead of letting market forces operate, they lock the doors. They freeze exchange rates at artificial levels. They create restrictions on transactions. They make it harder to convert currency, to move money across borders, to exit positions. And every time they do this, they're admitting the same thing. If we let capital move freely, it will flee. The exchange rates froze instead of clearing. That's the critical detail. Currency markets are supposed to find equilibrium through continuous trading. Buyers and sellers meeting, prices adjusting, markets clearing. But the rates stopped adjusting. They froze at levels determined by authorities, not markets. And when you try to transact at those official rates, you can't. The liquidity isn't there. The counterparties aren't willing. The exchange doesn't happen. So two markets form. The official rate on screens that means nothing, and the real rate, the rate at which actual transactions can occur. That's much worse. and the gap between them is the cost of being trapped. This benefits someone. Authorities buy time. That's the entire purpose. They're not trying to strengthen their currencies. They're trying to prevent capital flight that would reveal how weak their currencies already are. They're not managing stability. They're postponing instability, buying days, weeks, maybe months before the pressure becomes impossible to contain. And while they buy time, they're spending your capital, your liquidity, your ability to exit. You're paying for their time with your trapped money, and the longer they maintain control, the more you pay. The sophisticated money already left. Anyone with serious capital saw this building. They diversified months ago. They moved assets to jurisdictions with no exit restrictions. They converted to currencies that don't require permission to exchange. They positioned before the lockdown, and now they're watching the exits close, watching rates freeze, watching capital get trapped. And they're calculating when to move back in, when to buy assets cheap from sellers who can't hold anymore, who have to transact at whatever rate they can get because the official rates won't clear. This hurts you. If you're holding savings in a currency that just restricted exits, you can't move that money without accepting massive losses. If you're trying to make international payments, the official exchange rate doesn't matter because you can't access it. If you're holding assets denominated in restricted currencies, those assets just lost liquidity, lost the ability to exit cleanly, and liquidity is value. When you can't sell something easily, it's worth less. Not theoretically, in practice, in the price you'll actually receive if you need to transact. Here's the mechanism destroying you. Capital flows create pressure on exchange rates. When capital wants to leave, it sells the domestic currency and buys foreign currency. That selling pressure should make the exchange rate adjust downward. The currency weakens. But if authorities don't want the currency to weaken, if they can't accept what a market clearing rate would reveal about their economy, they restrict the exits. They make it hard to sell the domestic currency. They freeze exchange rates. They control capital flows, and your money gets trapped in the middle, trapped between what the currency is officially worth and what you could actually get for it if you could transact freely. The fear replaced flow overnight. That's how you know this is serious. Currency markets are supposed to operate continuously, 24 hours, global participants, constant flow, money moving from weak currencies to strong ones, from low-yield environments to high-yield ones. The flow is the market, but the flow stopped, not because participants stopped wanting to transact, because authorities stopped allowing them to. The fear that capital would flee became so acute that authorities chose to prevent all flow rather than risk showing how much capital wants out. This won't stop, because the pressure only builds. Capital that wants to leave doesn't stop wanting to leave just because exits are blocked. It waits. It builds up behind the restrictions, like water behind a dam. And every day the restrictions remain, more capital accumulates, more pressure builds, more participants decide they need to exit. And when the restrictions eventually lift, if they lift, the accumulated pressure releases all at once. Days of suppressed capital movement happens in hours. The currency that was artificially frozen crashes to where it should have been all along. And everyone still trapped absorbs the loss in a compressed window. The authorities know this. They know the pressure is building. They know the restrictions are temporary at best. They know eventually market forces overwhelm control. But they're betting on eventually being far enough away that the immediate crisis is avoided. They're buying time to restructure, to build reserves, to create conditions where they can lift restrictions without immediate collapse. But building those conditions requires time. And the only way to buy time is to trap capital, your capital, while they prepare for whatever comes next. Money stopped moving and went silent. The transactions that were happening aren't happening anymore. The flows that were active went quiet, and silence in currency markets is terrifying. Because currency markets are supposed to be noisy, constant activity, continuous pricing. When they go silent, when transactions stop, when flow ceases, that means market forces have been suppressed. And suppressed forces don't disappear. They compound. They intensify. And when they finally express themselves, they express violently. The regional markets are bleeding. Small businesses that operate across borders can't transact. Import-export operations that depend on currency exchange are stuck. Companies with foreign obligations can't make payments. Workers with remittances to send can't transfer money. The entire economic activity that depends on currency movement, which is most economic activity, is freezing. Not because the economy stopped, because the currency system stopped. And while it stopped, every participant is suffering, losing opportunities, losing contracts, losing connections, while authorities maintain the fiction that everything is orderly. Any relaxation could unleash days of pressure in hours. That's the trap authorities built for themselves. They can't maintain restrictions forever. Eventually they have to loosen. Eventually they have to let some transactions happen. But when they do, they risk triggering the exact capital flight they were trying to prevent. Because the pressure has been building. The capital that wanted out weeks ago still wants out. Plus all the new capital that wants out because restrictions spooked it. All of that accumulated desire to exit waits for the first opening. And when that opening appears, it floods through, overwhelming whatever relaxation was attempted, forcing authorities to either reimpose restrictions immediately or watch their currency collapse. This feels like control snapping shut just before something breaks. That's the pattern. That's what authorities do when they sense structural failure approaching. They don't address the fundamentals. They don't fix the problems. They lock down the system. They prevent the market from expressing what the fundamentals suggest should happen. They trap participants, force them to hold positions they want to exit, force them to accept official prices that don't reflect reality, and they maintain this fiction for as long as possible, until the pressure becomes impossible to contain, until something breaks despite the controls, until the lockdown becomes the crisis instead of preventing it. You're holding assets in currencies where exits just closed, where exchange rates just froze at artificial levels, where authorities just revealed they're afraid of what market forces would do if allowed to operate. And you're positioned as if this is temporary, as if the restrictions will lift soon, as if when they lift, you'll be able to exit cleanly at reasonable rates. But the people who already exited know better. They know restrictions that appear suddenly don't disappear quickly. They know capital controls that lock without warning stay locked longer than authorities promise. They know currencies that need exit restrictions to maintain their rates are currencies whose real value is much lower than the official number suggests. The countdown started the moment the exits locked. Not countdown to resolution, countdown to breakage. Every day the restrictions remain, pressure builds. Every day capital can't move, more capital wants to. Every day exchange rates stay frozen, they drift further from where they should clear. And somewhere in that accumulation of pressure, of trapped capital, of suppressed market forces, something gives. A major participant finds a way to exit anyway. A hole in the restrictions gets exploited. A parallel market forms where actual transactions happen at real rates. And once that happens, once the official fiction breaks down even slightly, everyone else rushes for the same exit. The lockdown becomes a stampede. The controlled environment becomes chaos. You're watching currencies reveal themselves, Not through official statements, not through policy announcements, through actions, through restrictions, through controls, through exits that lock and rates that freeze and flows that stop. Currencies that need this level of control to maintain their value don't have that value. They have the illusion of value, sustained by restrictions, by trapped capital, by fear of what would happen if market forces operated freely. And that illusion only lasts as long as the restrictions hold, as long as participants stay trapped, as long as the exits stay locked. The authorities are betting they can maintain control long enough to matter, long enough to restructure, long enough to improve fundamentals, long enough that when they finally relax restrictions, capital doesn't immediately flee. But they're betting with your money, your trapped capital, your inability to exit. You're the collateral in their bet that control works, that restrictions buy enough time, that eventual relaxation happens in an environment where flight doesn't occur. And if they're wrong, if the pressure is too great, if the fundamentals don't improve, if capital rushes for exits the moment they crack open, you absorb the loss. Not them, you. Because your money is the money that's trapped when the bet fails. The exits locked, the rates froze, the flow stopped, and somewhere behind those locked exits, capital is accumulating. Pressure is building. Participants are planning, waiting for the first crack, the first relaxation, the first moment when movement becomes possible again. And when that moment arrives, the accumulated pressure doesn't ease out gradually. It explodes. Everything that wanted to move but couldn't moves at once. And currencies that needed lockdowns to maintain their rates discover what they're actually worth when market forces operate. And holders discover what their trapped capital is actually worth when they finally get the chance to exit. And the gap between the official rate during the lockdown and the real rate after it breaks is the price you paid for trusting that strong currencies don't need to trap capital to keep it.